Humans are inherently terrible at investing in Bitcoin. We are driven by wild psychological extremes, experiencing intense FOMO, or fear of missing out, to buy in at the absolute top, and then panic selling our assets during routine market corrections. Instead of holding positions, investors get distracted by global geopolitical events. They abandon long-term strategies, scrambling emotionally into physical commodities like oil or silver. We can actually measure this collective irrationality. The Fear and Greed Index is a daily metric that tracks market sentiment, quantifying exactly when the masses are terrified and when they are dangerously overconfident. This continuous cycle of emotional trading creates a dense wall of noise. For the average person, that noise makes it impossible to see Bitcoin's actual underlying long-term trajectory. So, what happens if we execute a thought experiment?
What if we mute human emotion, ignore the 24-hour news cycle, and ask an objective machine to evaluate the asset? When AI models are fed the data, they look at specific inputs. This visualization maps out historical 4-year halving cycles, programmed events that cut the new supply of Bitcoin in half. It then overlays regression models and power law mathematics, which are equations that calculate how asset growth curves stabilize over long periods of time. The AI doesn't read the headlines. It immediately filters out the short-term volatility that terrifies humans to isolate the true, underlying mathematical trend. When human panic is completely removed from the equation, Bitcoin's future price action shifts from a chaotic gamble to a highly deterministic mathematical certainty. This chart shows the projected drop for the current cycle's bear market. The AI calculates an absolute bottom for this period, establishing a firm support zone between $45,000 and $55,000. While human investors look at this dip and scream that the asset is going to zero, the AI recognizes the exact same price action as a historically backed standard baseline of support. The AI reveals its projected timeline for the next all-time high. It targets a 32-month window following the bottom, arriving around 2028 and 2029. It provides a specific price target for that peak, locking in at $250,000 to $350,000 per coin. You do not need to stress over timing the absolute bottom perfectly. Simply trusting the AI's midterm baseline and entering near the floor guarantees a massive multiple on your initial investment. If we zoom out from the 4-year cycle, institutional macro models tell an even larger story. A recent comprehensive report from Bitwise pushes the prediction out to the year 2036. They analyze the global store of value market. This is the entire pool of assets where humanity parks its wealth to preserve purchasing power, and economists project it will grow to $121 trillion over the next decade. To gauge Bitcoin's trajectory, we compare it to gold. Gold grew from a $2.5 trillion asset in 2004 to roughly $40 trillion today. This pie chart represents the future $121 trillion global wealth pool. The mathematical formula to reach $1 million Bitcoin is simple. It only needs to capture 17% of that market. Securing that 17% share directly translates to a valuation of $1 million per coin. $1 million Bitcoin relies entirely on a highly conservative mathematical acquisition of an expanding financial pie. Major Wall Street institutions have run this exact same math. They realize their traditional fractional reserve lending models, a system where banks only keep a small percentage of deposits on hand while lending out the rest to manufacture debt, face a direct existential threat. The hypocrisy among legacy executives is staggering. In 2017, Jamie Dimon publicly attacked Bitcoin as a criminal scam. Today, JPMorgan is rapidly building out blockchain infrastructure and managing Bitcoin ETFs. Yet, while Wall Street aggressively adopts the technology, traditional banks are actively blocking retail investors, frequently denying everyday users from transferring their own funds to buy crypto. The banking sector is intentionally using regulatory friction to slow down average citizens. They restrict retail access while institutions quietly accumulate the asset to control the future timeline. The only way to beat this institutional manipulation and capture the AI-predicted wealth is through sovereign self-custody. This means holding your digital assets on a secure private hardware device completely outside of the banking system. To do this, investors must face a significant emotional hurdle. You have to accept severe, sudden price volatility as a mandatory feature of a new digital economic reality, rather than a bug. The emotionless algorithms have already proven exactly where the math is heading. The only remaining variable is whether your own human fear will force you to sell before you arrive.